Cut through the confusion, understand the crisis, prepare for the future at Decoding Rickards. I would say that the Fed may actually cut rates sooner than Michael Wilson expects, and maybe sooner than a lot of Wall Street expects. And you say, well, Jim, isn't that good for stocks? And the answer is no. Because the reason they're going to cut rates is because things are going to be much worse than even Wilson and others expect. This will cause the economy to crash. And then you will pivot not because you want to, but because inflation might be zero or could be negative. We could actually be into deflation. We're already in disinflation. Disinflation is when you still have inflation that's coming down. That's still inflation, but it's coming down. Deflation is when prices actually go down. Inflation is negative. It's not a question of going up at a slower rate. It's a question of actually going down. And then that feeds on itself. That's the central banker's worst nightmare. Because people say, why should I buy anything? I'll just sit on my money and wait for the price to come down. Maybe buy 6 months from now, or maybe wait a year. And then that feeds on itself. Then unemployment goes up. Businesses shut down, stock markets crash, And the Fed pretty quickly turns around and cuts rates. Now we've actually seen this movie. And it wasn't that long ago. Go back to 2015. December 2015, that was the famous liftoff. Remember, interest rates had been at zero. I believe for 6.5 years at that point. The zero interest rate policy. And then Janet Yellen raises interest rates 25 basis points. Okay, it was a baby step, but at least they went up for the first time in 6 or 7 years. And it was actually longer than that because there was a series of cuts to get to zero. So the last time they had raised rates was even further back, like 2006. So that was more like 9 years. So she raised this interest rate 25 basis points and then waits a year. The next rate hike was December 2016. They waited a whole year just to go 25 basis points more. Almost as if they would have been embarrassed if they had done nothing in all 2016. I think it was the only reason they did it. But then when Powell came in 2017, that tempo picked up. It was kind of a nothing burger for a year and a half. But then Powell's like boom, 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 boom. You had 25 basis point hikes and got the rate all the way up to 2.5, which doesn't sound like a lot. But considering that they had been at zero for 6 years, that was pretty steep. But what happened between October 1st and December 24th, 2018? The stock market collapsed. I mean the Dow, Jones, the S&P, the Nasdaq. All fell about 20%, just short of a bear market. It was like 19.08%, 20% to all intents and purposes. But that was in less than 3 months. And the Fed kept raising rates in the middle of the stock market crash. This shows you how out of touch they are. And how behind the curve they are. So the last rate hike was December 14th or 15th. It was right around the middle of December. 14th or 15th, even after 2 months of crashing stock prices. They raised rates one last time. They just kept going, and kind of what we're talking about earlier. And then finally on December 24th, what I call the Christmas Eve massacre. The Nasdaq fell 3% in one day. Dow was like about 1.8%, S&P was over 2%, and the Nasdaq was 3%, and then the Fed got religion. Like, we went too far. We're the last to know as always. So early January 2019, Powell said, use the word patient. It's one of those code words. It means we're not going to raise rates unless we tell you. So they were on pause, and then by late 2019, they cut rates. And then along came COVID, and by March 2020, they were back to zero. You had this huge round trip from zero in November 2015 to about 2.5 in December 2018, back down to zero by March 2020. What was that all about? Well, the Fed went too far, didn't know what they were doing. The economy was weaker than they expected. They raised rates. So bring that scenario forward to today. I feel like I'm watching the same movie. Okay, the Fed's got the gumption. Raise rates, raise rates, raise rates. Now they're much higher than they were in 2018. But they're flying into a hurricane. They're flying into a very weak economy, seen by a lot of metrics: housing starts, global trade, ISM surveys, industrial output, inventories. There's just tons of negative data. It's not the kind of thing that makes headlines the way CPI does, but it's all there. It's hard data. So it looks like a bigger, better version of what happened in 2018. I would expect a worse outcome. Thanks for watching. If you found this helpful, please give the video a thumbs up. For more content, hit subscribe button and bell icon.